Many thanks for joining our webinar today. I'm Catherine Patel. I'm one of the partners at Buzzacott. Today we're going to be looking at the implications of the November 2022 ONS announcements and the impact on FE colleges. Delighted to be joined today by both my colleague Saatchi Blakemore, also a partner in Buzzacott's charity and not-for-profit team, and also Chris Patterson from the ESFA. Just on housekeeping for the webinar, just to note that videos are automatically off and that you're also on mute. We're going to have time for questions, so please do ask any questions through the Q&A function in Teams. That's accessed on the right hand side of your screen. I believe it's through the question mark in the speech bubble. Questions are anonymous from others as well. So we'll try to get to all questions as part of this session, but if not, we'll respond afterwards in a follow-up communication to you. We'll also be sharing both the recording and the slides from today's session as well. So just turning to today's agenda, probably up to about an hour in length, and that will depend on the number of questions raised. Saatchi is going to start off. She's going to look at the changes that were announced by the ONS. I'll then briefly look at some of the governance considerations for colleges, and then we'll hand to Chris to look at this from the ESFA's perspective. I have to say many thanks to Chris for taking the time today to join us. So I'll now hand over to Saatchi.
Thanks, Catherine. So in terms of the changes, as Catherine mentioned earlier, they became effective at the end of November, 29th of November, to be precise. And certainly my recollection was that we've all been through the audit committees for colleges, and colleges were then in the process of preparing for corporation meetings to approve the financial statements. Largely for most colleges, that the timing and the immediate effectiveness didn't have a sort of immediate bearing on the financial statements for 2022, but certainly from our experience, there were a handful of colleges that we work with where the new borrowing requirements, which I'll talk about in a bit more detail, meant actually that if they were using their borrowing facilities in the coming year, they would need permission from the ESFA, and it meant that they had to very much get approval from the ESFA. In some cases, the financial statements ended up being approved after the year end. But aside from that, why have the changes come in, and what is the basis for the change? Certainly it's around the control element. Essentially, government does have a significant level of control on further education colleges, and particularly that was kind of made explicit following the sort of Education Act 2022. And on the basis of that, colleges like academies, for example, are now deemed as part of central government. What does it actually mean? It means that colleges are now subject to managing public money regulations. In many ways, given the nature of the fact that you are funded and have always been funded by the DFE, in terms of compliance around those rules, most colleges were already complying, but there are some additional rules and regulations that come into effect. The ones that have already been announced relate to things like borrowing, pay controls, etc. And in light of those changes, there will be a financial handbook for colleges that doesn't come out this year, but I believe it's currently expected to come out in August 2024. Ultimately, and I've forgotten to say next slide. I knew this was going to happen, I apologise. We're on the next slide as well now. Yeah, so ultimately what it means when you're just looking at the financial statements of colleges, this reclassification is really all about the fact that, you know, you will end up having to consolidate your accounts in government accounts, and it's something that academies have always had to do as well. And the timetable for that, next slide please, the timetable for that, well, it's not imminent. I think certainly it's fair to say that this financial year 2022 23 and the next one, there's minimal changes to be expected. There is a request that will be going out to colleges in relation to regularity of transactions up to 31st of March, but I'll leave Chris to talk about that in a bit more detail. The likelihood of the the accounts being consolidated in government accounts is likely to be 24-25. And the mechanism, it may well be, I mean, I'm speculating, but I'm sort of basing it on our experience working with academies, is through what's called an accounts annual return. So the accounts are audited as they are for colleges at the moment, but there would be an extra return that would essentially be the same for colleges, and that would enable the consolidation to take place. I think one other change which is currently being debated, and some of you may well have actually fed into the consultation, is around the change in year end. There is a suggestion that there might be a move towards 31st of March. Of course, it has not just the sort of practical implications both for colleges, their auditors, but also the funding rules, because you're currently funded on an academic year, and what would that mean in terms of revenue recognition. But that's sort of the tip of the iceberg. There are various other things that will need to be taken into account. So it's just kind of preparing for the possibility that probably 2-3 years down the line, there might be a change in year end, and how finance teams and indeed audit committees, etc., start to think about the financial statements of the college and the audit findings. Next slide, please. So if I can just go through some of the changes that have been announced to date. The changes have been announced through about 5 bite-sized guides, and at the start of my slide there's a link that I've attached to it, so you can see a bit more detail into it, but as the name suggests, it is bite-sized and very much it's fairly succinct, so easy to understand. But some of the changes that I just wanted to raise, the key change so far, and the most significant, is around borrowing. And the key word is consent. Consent will be needed. So any new borrowing that colleges want to enter will have to be, you have to seek permission from the ESFA. Equally, if you've had existing overdraft facilities, borrowing facilities that you haven't utilised, in order to utilise that, you need permission. And that's the point I was making very early on when I started to say that when we got to signing off 2022 financial statements, there were some colleges that were planning to utilise those facilities, and this new rule meant that they actually had to seek the ESFA permission first. Equally, if there are amendments to loan facilities that you're considering, that needs to be factored in, and again, communication with the ESFA is needed. The one area that you are exempt currently is finance loans. Academies have similar rules around borrowing. For example, they need to seek permission, but they can't get finance leases. Certainly for colleges at the moment, you will continue to be able to enter into finance leases. They're not quite under the definition of borrowing as currently stated. Next slide, please. So in terms of the other area where consent or permission will be needed is around staff pay and severance payments. So for staff pay, anything over 150k that's being awarded as part of pay will need permission. And this isn't so much retrospective, but it's prospective, in that if you have existing personnel who are being paid that, you don't necessarily need to seek permission, but of course, if their role becomes vacant, they leave the organisation and you're fulfilling that role, and the quantum awarded as salaries above 150, you will have to again get permission. Likewise, you have to get permission for all ex gratia payments, irrespective of the quantum. If you have severance payments, then and they're being awarded to individuals who are paid more than 150, you get permission. Similarly, compensation to the value of 50k or 3 months salary needs communication first with the ESFA. The only area you don't currently need permission is if you're awarding pay in the usual way. Anything up to 9% at the moment is permissible. Next slide, please. There's also rules around write-offs and letters of support. So what do I mean by write-offs? Bad debt write-offs. Anything where monies are due to the college and there's a decision being made that you're not going to pursue the funds. If it's over 45k as a sort of an individual transaction or 1% of income, then you first need to actually seek the ESFA's permission before you write it off. Or likewise, if you have smaller amounts, but they actually exceed 250k, and that's quite important to remember that, then you also need to get the ESFA's permission. If you're providing letters of support, and certainly know with some of our colleges that we work with, they have trading subsidiaries, for example, where often, because the trading subsidiary is just in its sort of infancy, hasn't quite managed to accumulate surpluses, or indeed it's gone through a period like it has during COVID, where it's been in negative reserves. There's been a letter of support from the college. That's been issued very much without any sort of need to consult the ESFA, but certainly as far as we're aware, that permission will be needed going forward. Next slide, please. Other areas to just be aware of are novel, contentious and recursive transactions. Novel really is that it's something out of the ordinary business that the college does. Contentious is where it's likely to be criticised, and potentially also by external stakeholders, media, etc. And recursive is that there is not, so sort of a wider impact in terms of, you know, the college does something, it then sets a precedent for the FE sector, and there's a potential financial implication. Now, you can understand that obviously all of these areas are highly subjective. And the ESFA currently hasn't published a list of everything that could be considered under those three categories. Perhaps it's something that will be developed over time. But I guess, you know, prudence and a sort of a realistic assessment of whether certain things you're anticipating undertaking that previously you may have not considered needing the permission of the ESFA, that there is now a requirement to consider that. Asset sales, and I know Chris will talk about it later, because I think, Chris, that there may be potentially a change, but if you sell assets and you get proceeds from it, you can actually ring fence those funds, or you're required to ring fence those funds for further capital work for the time being. Non-changes are important because certainly before the 29th of November, there was a lot of debate in the sector, an anticipation that there would be certain changes which would be beneficial for colleges. So one of those was around the recovery of VAT. Most colleges don't recover most of their VAT, and it's a significant cost. On the other hand, academies can recover pretty much most of their VAT costs, which for most organisations at least is a sort of a six-figure sum, and particularly in the current economic climate, you can imagine that recovery is incredibly helpful. There was certainly an expectation from the sector, or certain organisations in the sector, that the same would be extended to further education colleges. But it's been made clear that the reclassification to ONS and the VAT aren't connected, and currently colleges cannot reclaim their VAT, so the status hasn't itself changed. Likewise, with academies, for example, they also have local government pension schemes for support staff, just as further education colleges do, but they're guaranteed by the government. So the event that the organisation is essentially winding up, there's a guarantee that that pension liability would be made good by government. And what it translates into is often the risk assessment of those pension schemes is deemed lower, and potentially the sort of the employer contribution element, which is the financial impact on the organisation, tends to be lower. And again, there was an anticipation by some that same offer would be extended to colleges, but it hasn't been extended thus far. And then the final thing I just wanted to say on the changes, before I move on to the next slide, is that you can currently retain the reserves that the college has built up. Again, there was some debate prior to 29th of November as to what it would mean in terms of built up reserves for colleges. So what are the practical implications? I think the key one out of all the changes is the borrowing, because the quantum involved is significant. It impacts your cash flow, it means forward planning, and I think there has to be some mechanism for colleges that have borrowing arrangements that haven't even yet been caught out by the new requirements to really monitor those banking arrangements, and if there are any changes, to really start the process of liaising with the ESFA as soon as possible. Policies and procedures, no doubt, will need to be updated in light of some of the changes in terms of limits, etc. And that's quite key. And there will be more bite-sized guidance coming along. So thus far, it's only sort of 5 or 6 areas that have been clarified, but there'll be more coming along the way. And I think the general thing is around sort of awareness. Sorry, next slide, please. The final thing is just around the knowledge and dissemination of these changes. There are many channels of communication. The ESFA obviously have been communicating about these changes. There have been seminars they've hosted. Same with the AOC and professional advisors like us today that we're hosting this. But it's important, I think, at all levels within the organisation that these changes are understood. And the key is that to be able to make sure that you comply with the new requirements. That's all I wanted to say, and I'll hand over, next slide, to Kath.
Great, thank you very much, Sachi. So I'm just briefly going to look at the areas for colleges to consider as a result of these announcements from a governance perspective. Excuse me. So if we could just go to the first slide. So really considering the overarching governance frameworks, and ultimately these remain predominantly the same overall. We're sort of looking here at the existing frameworks that exist from an FE perspective, but also looking at those that exist, and such as mentioned the academy world, the academy sector, and looking at some of those and just thinking about where some of these ONS changes may impact on governance. In terms of colleges, they continue to remain as exempt charitable status, with the Secretary of State for Education as the principal regulator. Colleges continue to operate within the public sector. They remain as self-governing statutory corporations and have that annual funding agreement with the ESFA. And really overall in terms of the governance framework, so colleges must continue to follow the Nolan principles of governance, have the requirement to undertake regular governance reviews, and the requirement to comply with one of the 3 governance codes. I've noted those there being the Charity Governance Code, the Code of Good Governance for English colleges, and the UK Corporate Governance Code. And those requirements are set out in the key DfE governance document for colleges, so which is the FE and Sixth Form College Corporations Governance Guide. So that was last updated in March 23, so just a few weeks ago, and that was partly due to the impact of the Skills and Post-16 Education Act. So for example, to reflect the requirement for colleges to consider local skills, but also partly for the update due to the ONS announcement. So for example, within there, the section on executive pay notes the requirement from the 1st of May this year to have the approval from the ESFA for the pay related points that were mentioned by Sachi. So for those higher paid employees, for example. We also have the insolvency regime that continues, and that's important. We'll come on to going concern in a little bit of detail. That's important when we're looking at going concern, but the insolvency regime that was introduced in recent years continues to be applicable. So with the onus on the governors, on the corporation, to identify issues that may impact the financial sustainability, the solvency of the college, and absolutely critical for governors to take that immediate action to seek professional advice should there be concerns over the solvency of the college. So that really just sort of sets the scene in terms of the governance frameworks and what you're operating within when you're considering what might be some of these changes and the implications to consider from the ONS announcement. So if we just go to the next slide, please. So really, what does the college need to consider from a governance perspective? So from an accounting officer's perspective, so the principal, the CEO in their role as accounting officer, takes personal responsibility for safeguarding the public funds for which they're accountable and for meeting the overall legal requirements. So this includes the responsibility for regularity and propriety at a college, with that annual statement being made by the accounting officer and the chair of governors within the financial statements on regularity. So really key considerations there for the accounting officer. What will impact and relate to the compliance, so really thinking about the compliance with the new requirements. So how will regularity be impacted? How is the college management team seeking those relevant ESFA approvals on a timely basis? So really accounting officers' ultimate responsibility to ensure that those approvals are being sought, whether that's for borrowing, whether that's for pay, etc. The role of the corporation and subcommittees also, again, really critical here in terms of them having oversight for the required approvals, making sure that approvals have been sought from the government, and relevant returns submitted as well. So what is the degree of oversight required by the corporation and also then within the various subcommittees? So, for example, will the Finance Committee have that clarity around the financial returns that are now required, the approvals to be sought? So will they can act as a check, for example, on the borrowing, that those approvals have been sought? The Pay Committee, Remuneration Committees, here considerations around those specific approvals for executive pay, higher paid staff, and also the Audit Committee as well. So in terms of the Audit Committee, their responsibility for ensuring an adequate control environment, adequate risk management procedures, and making a statement within the financial statement. So taking into account the ONS requirements within that overall control framework, the risk management framework as well. Subsidiary company boards, falling within the remit of the requirement. So what are the considerations for the company directors here? Saatchi mentioned it, but the letters of support that are required potentially for some subsidiary boards in order to ensure that future financial solvency. Obviously for the directors of those trading companies to very much bear in mind the need for approvals of letters of support. What are contingency plans? Will those approvals come through from the ESFA as required? So I think overall for governors, it's really considering which elements of this are being delegated to management, what are the reporting requirements to committees and overall corporation as a whole, and whether there are any specific approvals or authorisations that are required at committee and corporation level. But from an audit perspective, really the overall work will largely remain the same, falling under the Audit Code of Practice. For the core external audit on the true and fair view of the financial statements, I would anticipate that remains very similar, and that's obviously subject to the audit of any additional disclosures or narrative that are required within the financial statements. Internal audit, there may be riskier areas that are coming out of this when you're looking at your risk management processes. Is there anything here that you need to direct your internal auditors' work towards as a result of these announcements and changes in frameworks? And then I think the main area, as I alluded to under the role of the accounting officer, the main area that will change here is regularity. So really, as auditors, that we're checking that the appropriate levels of appropriate approvals have been sought and that transactions are deemed to be regular and proper. So if a college failed to seek the appropriate ESFA approvals for a transaction, that's likely to lead to a modification of our regularity report within the financial statements. And we see that already very much within the academy sector, because they've been subject to a lot of this over recent years as well in terms of the overall frameworks. From a financial statements perspective, I think it largely is the reporting consideration. So presumably the accounts direction will pick up on some of these new requirements and really notify colleges where additional disclosures are likely to be required. So again, in the academy sector, we see a requirement to disclose certain types of transactions, and particularly those where the ESFA has had to approve certain transactions. So Saatchi mentioned write-offs and losses, for example, may have to be disclosed separately. That would come through in due course. And then I mentioned going concern and the insolvency regime, so the overall requirements and onus on governors around the solvency and financial sustainability of the college, but really looking at that and in the context of the ONS requirements in terms of going concern. So the governors having a requirement to look at the going concern basis for the preparation of the accounts. They're looking at the period at least 12 months from the date of approval of the accounts. So if a college needs new borrowing to come through and that is going to be sought from the DFE, or they need approval to use existing facilities, how does that impact the sign off of the going concern basis for the accounts? And this, as such, you mentioned this for the 2022 accounts because of the timing of the announcement caused some delays. I think over time it will get into a routine so that the timing there works and fits with sign off of accounts. But nevertheless, it is something as auditors we will be looking at to ensure that those relevant discussions are happening with the ESFA in terms of borrowing, and particularly if that borrowing requirement falls due within 12 months of the date of approval of the accounts, it can have quite a major impact in terms of timing for sign off or potential modifications for your audit report. So that was all I was going to cover from the sort of the governance perspective and from a governor's position in terms of sort of the oversight and regulation. But I'll now hand over to Chris, who will look at this from the ESFA's perspective.
Thank you, Catherine, and thank you everyone for joining us this morning. I'd just like to say thanks to Catherine and Saatchi for giving the opportunity, obviously, to reach out to colleges and spread a little bit of the news, which we're trying to do through various other channels. So my name's Chris Patterson. I'm a team leader in the Education Skills Funding Agency. My primary responsibility, my day job, if you like, is financial reporting for colleges. So I lead on documents such as the College Accounts Direction, the Post-16 Audit Code of Practice, College Financial Planning Handbook, etc. But I've been working on and off, I suppose, on planning for potential sector reclassification since the summer of 2021. So a lot, you'll find my fingerprints over quite a lot of what Catherine's already set out there, and it's still a thing in development, I think. In any event, this morning I've been asked to talk about kind of the monitoring consequences for the sector. What's the impact going to be in terms of your relationship with the ESFA? Yeah, so that's what we're going to discuss, and I'll just by way of context, just to let you know, I've got a little bit of a cold this morning, so hopefully if it's a little bit hoarse, maybe you might want to just play me back on the recording. You might get a little bit of a better readout. So if we can move the first slide, please. So yeah, so as I said, I've been working on planning for reclassification since the summer of 21, and you might imagine from my own point of view, it's been kind of all consuming really, and you kind of you consider it's a big thing. It's and the more you work on it, the more importance you attach to it. But I think while it's legitimate, obviously, to focus on the elements of change, also I think, and as Catherine's kind of alluded to in her talk there about governance, I think it's also important to look at the aspects of continuity, the things which haven't really changed or which aren't going to change all that much perhaps. So yeah, so let's think about kind of the legal framework first of all. Colleges remain statutory corporations, they remain exempt charities, and the prime relationship with the Secretary of State is through a funding agreement, which is a sort of contractual relationship really, I suppose. Financial reporting, my thing, it's still in line primarily with the SOAP for the sector and the UK accounting framework. That hasn't changed. As Catherine said, in terms of governance, continues still to be run by governors who act as charitable trustees. Colleges were already following the public sector procurement rules. That hasn't changed. The financial health approach to colleges, that 4-tier ranking of financial health, that hasn't changed. The formula by which we determine financial health, that hasn't changed. The moderation criteria haven't changed. That's all the same as it was previously. The support and intervention framework, that's published, it's out there, that hasn't changed. It's changed ever so slightly, I think, perhaps, but in the main it's the same framework, and it's all very visible and transparent. And again, as Catherine said, you'll be subject to external independent external audit, as you were previously. So I wouldn't want to have the, I guess what we don't want to spook the sector and kind of give the idea that this is some sort of, like, you know, state nationalisation. That isn't what has happened here. There's been a change in the classification sector for the purposes of national accounts. That does mean some change, but I would, you know, I would like you to maybe think of those in the context really of a sector where much remains the same. So we can move to the next slide, please. So yes, having told you not to worry too much about the change, let's discuss the changes. Okay, so again, Catherine has gone through a number of these. So yes, the borrowing process has been curtailed, and Catherine's kind of set out what has happened there. And we understand, obviously, that is a concern for colleges, and we've tried to put in place processes whereby that doesn't cause a massive amount of dislocation for the sector. Yes, I want to talk about asset disposal. Colleges don't require consent to dispose of assets. That's previously, as was the case. There are some rules around what you can do with the proceeds, and the rule is that really they must be ring fenced for reinvestment in capital, further capital reinvestment. That's a little bit of a blunt message, I guess. You might like to think, well, you know, what about the kind of trivial amounts? What about small amounts of yes, the small amount of money I got for scrapping something which I'd written down to zero anyway. We're going to introduce some changes in that area fairly shortly, which is going to give a little bit more flexibility. So effectively what we'll be doing is, kind of the main focus, I suppose, really on the proceeds is going to be what you do with your big land and building type assets. I think you'll get a little bit more flexibility in in relation to what we might call chattels, I suppose. So watch this space. There'll be another bite-sized guide on that subject coming up fairly shortly. Yeah, public sector pay controls. Yeah, they have changed, as Catherine has said, and there's a bite-sized guide on those. Likewise, the subsidiaries, the trading companies which you may have, they're now fully part of the regime. So the rules, again, the transactional rules, which we've set out in the bite-sized guides and in the Dear Accounting Officer letter back in November, they will apply to the subsidiaries as well. So my question would be, and has the framework changed fundamentally? I would argue not. I would say that primarily such changes there have been relate to borrowing and probably aspects of the regularity framework. So if we could move on, please. So yeah, how do you know about the changes? You know about the changes which we've published through the Dear Accounting Officer letter, which we published on the day of the reclassification announcement on the 29th of November 2022. That's still available on gov.uk if you search for it. Likewise, we've published bite-sized guides on, I think it's 4 or 5 different topics associated with the transactional aspects of some of the regularity type changes. Stuff where you need permission, I think, really. So it's been stuff like losses and write-offs, special payments, that sort of thing. And as I've said there, there's likely to be a new one coming shortly on asset disposal proceeds. We've put in place a borrowing consent process that was set out in the annex to the Dear Accounting Officer letter on the 29th. And We also, again, as Catherine said, something which kind of took us a little bit by surprise, this business about letters of comfort. That was, for us, that was a little bit under the radar. I suppose if we'd stopped to think about it, we should have perhaps planned for the fact that colleges with loss-making trading subsidiaries may have been asked by the directors of those subsidiaries to issue letters of comfort in order so that the auditors of the subsidiary can sign off the accounts on a going concern basis. That was all kind of invisible to us. It was kind of all hidden. It's not something which got reported to us previously, so we had no previous kind of knowledge or insight into that. That came up at the end of, well, yes, as Catherine said, the reclassification announcement came really right in the middle of audit season, and we had to move at pace in order to put in place a procedure whereby letters of comfort could be issued under certain circumstances, and what we've got effectively is for 1 year a blanket permission for that to happen. So more stuff which we have to do coming forward, and what I've already mentioned that we're going to have at least one more bite-sized guide on asset disposals. There will be, and I know because I'm writing it, a college financial handbook, which I think Sachi said earlier on would be out by August 24. The plan is to have it out by March 24, in fact, but for it to be applicable, if you like, from the beginning of the 24-25 academic year. And that's very much going to be a collaborative effort with the sector. We've already got a collection of college CFOs and others on board to help us with the development of that. And you know, it's quite important, I think, really. And this is what we've learned over the years from our similar type work with the academy sector. It's really important. You've got to take the sector with you here, otherwise you end up writing rules which don't work in practice. We will be doing a light touch review of the college accounts direction. That will be for the year 22-23, and I think most of that will be the changes. We'll be focusing on new disclosures. So for instance, it's already been mentioned how they say new rules in regarding sort of losses and write-offs. We had no visibility of what was happening in the sector in regarding losses and write-offs. In order to kind of get a permission regime in place, we need to do a little bit of sampling. But we have no kind of, at this point in time, we've got no real visibility of what is happening in the sector in relation to losses and write-offs. We think that the majority of losses and write-offs probably are fairly trivial amounts. So that 45k threshold, which was mentioned there before, probably isn't going to bite in the majority of cases. But in order for us to get a handle on it, we are going to ask you to make some disclosures about those, so at least we know what's going on. And likewise, things like severance payments, again, a little bit rarer, I think, but we expect to see some additional disclosure requirements coming out in relation to those. We'll likewise be doing a light touch review of the Port 16 Audit Code of Practice. And again, as has already been mentioned, the focus there is likely to be on regularity assurance. So the statements of the accounting officer relating to propriety and compliance, and the scope, I think, of the reporting accountant's regularity review at year end. They're the areas where you expect to see some changes. I've put teachings question mark. I guess if there's an appetite for this from the sector, from the audit community even, we might have an opportunity this summer perhaps as probably part of the consultation process, or as kind of as the new policies kind of bed in a little bit, we could probably spend a bit of time maybe doing things like this, a little bit more of this for the sector as a whole. But again, it's we'll respond to feedback, and you know, if there is a demand, we'll probably do our best to plug it. So if we could go to the next slide, please. So this is kind of a new thing. It's quite a difficult concept to get your head around initially, but so what happens at the moment is for ESFA's own financial year, which is a traditional April to March year, so the year ends 31st of March, we have been able to rely on the regularity assurance coming from college financial statements for the prior year period, so the prior year ending on the 31st of July, for our assurance over the correct use of funds which we've paid out. That's what we call a lagged assurance. It's lagged because there's a number of months obviously between that year end and our own year end, and that's been fine up to now because there's been no disruption to the regime. National Audit Office have been content with that. They've said, well, okay, if it was regular in the period up to 31st of July, it was probably regular in the period up to 31st of July. But of course, reclassification changes that because it destabilises the regime. So as a one-off, what we're going to have to do for ESFA's own accounts for 22-23, we're going to have to ask colleges to send in a return to us, giving us any information on any of the managing public money driven transactions which fall out of reclassification. So the stuff on losses and write-offs, the stuff on special payments, the stuff on ex gratia payments, etc. We're going to have to ask you to send in a return. It is a one-off. It's, as I said, it's only going to cover part of the year from the date of reclassification, 29th of November to the 31st of March. We will rely on an accounting officer statement, so there's no requirement for the return to be audited. We may need to do a small amount of validation checking ourselves, but we ourselves will do that. It's not for your external auditors to do, and obviously we'll only do a sample sufficient in order to get a sufficient degree of confidence over the results of the whole sector. So you might say, well, this is a new burden. I would say, well, okay, it is a one-off. It's unaudited. Most of the returns are not going to be subject to any validation checks. If I'm trying to sell it to you, I would say, well, it's giving you an opportunity to go through the stuff which you're going to have to do at year end anyway, in respect of regularity compliance. It's the sort of stuff you would expect to see in your new expanded regularity self-assessment questionnaire, which boards are going to have to look at it at year end. So it's the same sort of considerations. And if you've had no such transactions, it's just going to be a series of no's, isn't it? So you're only going to have to tell us about stuff you've done, not stuff you haven't done. And we hope also, of course, auditors are going to be going through this process at year end, also when they do the regularity work at year end. So hopefully the return will be a little bit of a help for them when they're doing the regularity assignment at year end as well. So, okay, next slide, please. So I've been asked to talk about monitoring, and I hope what I've tried to get over is, I mean, other than perhaps the interim regularity return, what we're trying to do in relation to monitoring is to basically leverage the aspects of the existing framework so that they give us what we want. So the prime focus will be on the disclosures in your annual report accounts, the statement of your accounting officer, the statement of the corporation, the various new disclosures which are going to be in the accounts. So that's probably where the majority of the monitoring is going to be, just part of the annual cycle of monitoring which we undertake anyway. So borrowing, well, if there's any changes in your borrowing, we'll see that in your balance sheet, won't we? So that again, we're just going to use the annual financial statements in order to draw that out. Likewise, things, if there's been any sort of changes in senior pay, then that'll be evidence through the remuneration notes in the accounts as well. The new disclosures, which you will expect to see are going to be in relation to special payments, losses and write-offs. As I said, it's a big data gathering thing for us. It's quite important we get to know about it. Letters of comfort, guarantees and indemnities. Mainly that's just going to be they're sort of contingent liabilities, aren't they? So we're just going to see some sort of narrative disclosure in that area, I think, and we'll set those all out in our annual college accounts direction, which will be out later this spring. So next slide, please. So overall, so the impact of reclassification was immediate. if you like, the new rules applied in full from day one, even though you had no visibility of what those new rules were going to be. It's just the way it worked. You were there, then part of the sector, and the new rules applied. So you may think, well, that's a bit heavy-handed, isn't it? You know, how we could hold us to account for something which we didn't know anything about until the day in which it was implemented. Well, obviously, there are no consequences for what happened prior to that day. If you were free to make transactions without permission prior to the 29th of November, then that's fine, you were. The consequences for non-compliance going forward, I would say it's early days. I mean, we're trying to be understanding of the sector. We understand that we can't expect the sector to get fully up to speed with all of the rules from a standing start. That'll be unreasonable. Strictly speaking, compliance is a condition of your funding, and that is always was the case, I guess, really, and that's evidenced through the support and intervention framework. Our main focus, though, isn't on negative consequences. Our main focus is on understanding and support, and that's what we're trying to do. What we've tried to do through the Dear Accounting Officer letter, what we've tried to do through the bite-sized guides, what we'll continue to do through the college financial handbook. It's trying to make the college understand what the new requirements are, for them to get the buy into them, and likewise, I suppose, really the new stuff which is going in their annual report and accounts in relation to disclosures as well. That's still in that space as well. We will be facilitating process for retrospective permission if that is required. So if a college is kind of in good faith, if you like, written off some losses which they weren't entitled to do, and then you discover that you did actually, strictly speaking, require permission for that, well, just tell us about it, and we'll listen to you. We'll listen to the pros and cons, and if at all possible, that we'll take a permissive view of that, and we will grant retrospective permission, much as we would have done it if you'd applied for us in advance. There's no consequences really for doing it late. Obviously, better if you tell us early, better if you tell us beforehand, but we'll try to put things right with the college if there's a requirement for that to happen. So that's a bit of a sort of transitional type arrangement we take in. As I said, focus on support, focus on understanding, focus on giving you an opportunity to get retrospective permission. But I guess once the new handbook comes out, we're going to bring it out in March. That's the target, 24, and we're going to say it's going to apply in full from August 24. Well, we're giving you a good kind of full term and a half's run in there, really. So and obviously that's going to be, as I said before, it's going to be developed in partnership with the sector. Expect to see quite a big splash of publicity, I think, when that comes out. So I guess maybe we might it's not that we're going to be particularly stern or wagging our fingers or anything of the sort, but I guess really our expectations of the sector probably might be a little bit more might be a bit more realistic for us to expect that if you need such permissions, you come to us in advance rather than to fix things afterwards, I guess, really. As I said, time to get more serious. That's possibly for yourselves, but I mean for ourselves as well. And I think if we move the last slide, I think that is indeed my last slide. So and I think what I'm supposed to do now is hand back to Catherine. And I think, Catherine, I think you will possibly have a review of the questions.
Great. Thank you so much, Chris. That's, yeah, really, really interesting. I have a handful of questions just to run through. I think the first, just Chris, to give you a bit of a breather. The first I'll hand to Saatchi, and this was just a question around the 150k pay threshold and what that should include. Does it include on costs, pension, etc.? So I'll just hand to Saatchi on that one.
Thanks, Kath. 150 includes the base salary, but it also includes allowances. So if for some college principals, for example, they get travel allowance, they get housing allowance, that's part of the the 150. And in terms of pension, I believe it's actually if you're getting an additional pension allowance. So, for example, if you are if the contribution rate is higher than other people on the same scheme, or you have access to another scheme, then that would be part of that 150. As far as I can interpret, the employers' national insurance tax are not included on that 150,000. But in case, Chris, I am wrong in assuming that, I don't know if that's the correct interpretation of employers' national insurance and tax.
Yeah, so statutory deductions don't count as part of your remuneration, so that's nothing to worry about. I think the for those of you who kept an eye on the budget last week, obviously the lifetime ceiling on pension contributions was front and centre, wasn't it? And we were aware that I think over the last couple of years there've been some colleges, I think probably where the principal might have been bumping it along the bottom of that lifetime ceiling, and we had seen colleges which had made a payment in lieu of pension contributions, if you like, because clearly it wasn't possible to make the such a contribution without attracting the additional higher rate of tax. Such a payment, I think, would count as part of the remuneration package because it isn't strictly speaking a pension contribution. Well, and also I guess it would also attract tax and NI in its own right as well. But as I said, the statutory deduction element wouldn't count as part of the remuneration. So yeah, we expect colleges to kind of adjust, I suppose. There's more freedom now being given, isn't it? I think you're now entitled to make contributions up to 60k a year. So I guess we'll probably see these payments fade away a little bit, I think now.
Great. Thank you very much, Saatchi and Chris. This is probably a question more for Chris. So a comment that Academy Trusts operate on a September to August financial year end, which would be a minor change for colleges if they just had to move that 1 month, would still allow alignment with the academic year, the potential operational gains that come from that. The question really is why are you considering the change to a March accounting date when Academy Trusts have the August reporting date?
Yeah, so this isn't a done deal. This isn't a done deal. We're doing consultation on this at the moment, and we're listening to all the arguments pro and con. Obviously, it's the same team of accountants in the department who do the consolidation of the academies, which produce the annual, what they call it, sector annual report and accounts for academies. It's the same team, so they're fully well aware of the read across to academies. And we're also listening to the colleges. The colleges obviously are making representations to us about things like, well, it's natural to align with the academic year. It's natural to align with the funding year. I think there's going to be a little bit more water under the bridge before any decisions made in this. And it's if I had to put my money on it, probably think there probably will be a realignment of year end, but as I said, it's not a done deal yet. Okay.
Thanks, Chris. There was one comment which I think you actually then covered. It was a question more around how will colleges ring fence funds from capital sales, but I think, Chris, you said there that you'll be the ESFA will be issuing another bite-sized guide, so that presumably will cover some of the information there around the capital sales proceeds.
Yeah, I mean, the question is asked. Actually, it's not something I'm drafting the bite-sized guide. I hadn't actually considered the physical, or if you like, the accounting aspects of ring fencing. It's probably something we do need to cover in the guide. I mean, my first take on, do you need to establish a separate trust? No, I don't think you need to establish a separate trust. This is simply, I think, it's just it's just basically, if you've got some ring fence funds sitting in your ledgers, that's what it is effectively. We probably expect to see it disclosed as restricted cash, or probably on the balance sheet, but no, I don't think there's any kind of separate kind of legal trusts attaching to it or anything of that sort.
Great, Thank you. And then just one final sort of comment and linked questions to that. So sort of a comment that the managing public money framework doesn't necessarily apply directly to FE colleges, but that it's the funding agreements and the new college handbook that sort of apply that to the sector. And there were a couple of questions arising from that. Well, firstly, making the comment that the consultation process is really important. The first question arising from that was, do you agree there may be conflicts between some of the changes being made and the fiduciary duties of trustees, and how will that be handled by the ESFA? And I guess, Chris, do you foresee any potential conflicts here between the managing public money guidance and how that's then implemented within the sector and responsibilities of trustees?
Yeah, I think it's a little difficult to predict that on a general basis. I think it's probably going to be individual instances which are going to draw out that discussion. I think to be fair, we're fully aware of the fiduciary duty of trustees. We are aware of the responsibilities of the Secretary of State as the principal charitable regulator. We're aware of the fact that the relationship is focused, I guess, on the funding agreement, the accountability agreement, and probably expect to see some changes there, I think, as well. So yeah, I mean, we're going to, as I said, we're going to have a process of consultation with the sector when we develop the handbook. I would fully expect that to be quite robust, I think, really. And we ourselves, if we have issues where we think we've got an impasse over a particular area, then I guess we'll be speaking to our colleagues in the Charity Commission about that sort of thing, if there's a necessity to do so.
Great, thank you. I think we have a couple of minutes left. The only final question there, which was slightly linked to that earlier comment, was whether you could just say any more about the borrowing facilities that the DfE ESFA will be making available to colleges to replace the current facilities with commercial banks.
Yeah, I'm going to have to take a rain check on that one, I'm afraid, because that isn't my area, I'm afraid. I mean, there's guidance out there. If the questioner in particular has got specific questions, then I'm sure I can get somebody from the borrowing team to provide some additional information if that's required.
Okay. Thanks very much, Chris, and appreciate you being put on the spot to answer some of those questions as well. Yeah, really useful. Thank you. So I think that comes to the end of the session today. We've covered all the questions that were included within the chat. Obviously, anything further that you want to raise afterwards, then please do contact us. We're going to be circulating the recording and the slides after today's event. And really just to say many thanks for attending, and thank you again to Chris for attending, and Saatchi also for your presentation too. Many thanks.